Financial Education and Investment Awareness. Chapter 01, Foundation for Finance. Introduction to Basic Concepts. Understand the need for financial planning, basic concepts, life goals and financial goals, format of a sample financial plan for a young adult. Economics, meaning scope, key concepts influencing decision-making both micro and macro. Banking in India, types of bank deposits, deposit insurance, PMJDY. Traditional and new banking models. Debit and credit cards, digital payment system, internet banking, NEFT, RTGS and IMPS, mobile banking, mobile wallet, AEPS, UPI. Orientation to financial statements, financial terms and concepts, model for reading financial read. Statements, basic rations for evaluating companies while investing, time value of money. Compounding and discounting. Practical module. 1. Spreadsheet modeling. 2. Statistical functions in Excel. 3. Financial statement analysis in Excel. 1.1 Introduction to Financial Planning. The importance of financial planning is rising in the Indian community as one of the country's fastest growing service sectors as a result of global economic, technological, and social transformation. A well-developed debt market remains a distant dream, forcing investors to hold on to illiquid instruments. Senior citizens are facing the brunt of the impact of these changes, and as the average age of our population climbs, there is increasing pressure on an early introduction of a social security system for financial support. 1.2 Personal financial planning. Financial planning is the process of meeting your life goals through the proper management of your finances. Life goals can include buying a home, saving for your child's education, or planning for retirement. Personal financial planning is the process of managing your money to achieve personal economic satisfaction. This planning process allows you to control your financial situation. Every person, family, or household has a unique financial position, and any financial activity therefore must also be carefully planned to meet specific needs and goals. Financial education and investment awareness. Personal financial planning also refers to short and long-term financial planning by somebody, either independently or with the assistance of a professional advisor. 1.3 Meaning of personal financial planning. Financial planning is the process of developing a personal roadmap for your financial well-being. The inputs to the financial planning process are a. Your finances, i.e., your income, assets, and liabilities. B. Your goals, c. Your current and future financial needs, and c. Your appetite for risk. The output of the financial planning process is a personal financial plan that tells you how to use your money to achieve your goals, keeping in mind inflation, real returns, and taxes. In short, financial planning is the process of systematically planning your finances towards achieving your short-term and long-term life goals. 1.4 Financial goals. Specific financial goals are vital to financial planning. Others can suggest financial goals for you. However, you must decide which goals to pursue. Your financial goals can range from spending all your current income to developing an extensive savings and investment program for your future financial security. Such objectives may include short-term goals including savings for a deposit on a house or car, or savings for a holiday, and maybe for periods of up to 3 to 4 years. Longer-term goals of beyond 4 years include mortgage reduction, superannuation savings for retirement, and general wealth accumulation. Financial goals are generally classified as A. Short-term financial goals. Short-term goals are the more immediate expenses. Although timelines vary, these are the things you will spend money on generally within a few months or years. Short-term goal examples: emergency fund, payments toward rent, insurance, or student loans, credit card debt payments, personal goods, travel, wedding, minor auto repairs and home improvements. B. Long-term financial goals. Long-term goals are usually your big-picture costs. These goals may take several years or even decades to reach. These distant goals typically involve more money and regular attention than short-term goals. Long-term goal examples: retirement fund, paying off a mortgage, starting a business, saving for a child's college tuition. Financial education and investment awareness. 3. 1.5 Essential features of financial goals. The first step toward achieving your financial goal is to create a savings plan. The objectives are SMART. SL.NO. 1. Attribute specific. Description. Example: I want to save 3 lakh rupees to. This involves describing exactly what you wish to buy a new car. Accomplish. State exactly what is to be done with the money. Involved. 2. Measurable. Essentially, you want to decide on a unit of measurement for tracking your progress. 3. Achievable. To accomplish your goals, you'll need to plan out specific actions to make them a reality. 4. Realistic. You'll also need to set realistic goals depending on aspects such as your income, time, and abilities. 5. Time-based. Finally, you should set a deadline for when you intend to attain your objectives. I need to save 5,000 rupees a month for the next 60 months in order to have 3 lakhs in 5 years. This can be accomplished by working overtime at my existing job or starting a side business. Any incentives I receive will be used to buy a new car. To save money, I'm going to cancel my subscription, cable TV membership, and dine out less. I plan to improve my income by 10,000 rupees in a year. Jim. In 3 years, I want to get a new car. I will be able to accumulate 3 lakhs to buy a new car. 1. Planning resources for reaching financial goals. Savings are the prime source of reaching financial goals. However, more savings in the bank won't be enough. Savings should be channelized to various avenues of investment in order to achieve majority of the financial goals. To meet your various financial goals, we can invest in mutual funds, stocks, gold, land, and other assets. In reality, risk and returns are closely connected. The higher the returns, the greater the risk, and vice versa. 2. Review and prioritize. It's critical to examine the budget on a frequent basis to ensure that you're on track. Remember that the budget should work for you, not against you. Prioritizing your financial goals can mean the difference between not paying off debt and getting rid of. Financial education and investment awareness. It forever. It can mean the difference between paying off your mortgage or keeping it around forever. 1.6 Steps in the personal financial planning. The financial planning process is highly personalized. All psychological and financial aspects that may have an impact on your financial goals and objectives should be included in financial planning. Personal financial planning is a long-term strategy for your financial future that takes into account every aspect of your financial situation and how each influences your capacity to reach your goals and objectives. Financial planning has 6 separate steps. Periodically review your plan. GALTH ready. Draft financial plan. Steps in financial planning. Examine your current financial situation. Determine the present financial situation, including your income, expenses, debt, savings, investments, risk attitude, and tolerance capacity. This is the first step in financial planning because it provides you with a good understanding of the condition of your finances and opportunities for improvement. Financial education and investment awareness. Steps in financial planning. Examine your current financial situation. Determine the present financial situation, including your income, expenses, debt, savings, investments, risk attitude, and tolerance capacity. This is the first step in financial planning because it provides you with a good understanding of the condition of your finances and opportunities for improvement. Financial education and investment awareness. Develop your financial goals. Determine the various financial goals you intend to achieve in your life. Don't be afraid to write down any goal because there is no such thing as a small or big goal. Make sure the goals are clear. The established financial goals should be practical in nature and feasible within the time limits set for each of the goals. It delivers satisfaction and acts as a motivator. It serves as a financial planning directing function. Identify financial gaps. A simple formula can help you figure out how much money you'll need. This is critical since quantifying the income from your investments is required to determine the best investments to offset the shortfall. Right pointing arrow draft financial plan. Following goal formulation, plans are developed in such a way that the goals can be met as soon as possible. The financial plan outlines how to attain specific financial goals, whether to cut needless expenses or allocate savings to various investment avenues. Examine various investment choices such as equities, mutual funds, debt instruments such as PPF, bonds, fixed deposits, gilt funds, and so on, and determine which instrument or mix of instruments best meets your needs. The time span for your investment must match the time frame for your goals. Implement your financial plan. A financial plan is carried out in accordance with the goals established. The plan should be carried out in a systematic and consistent manner. The best investment option based on characteristics such as your goals, age, risk tolerance, and investment amount. Insurance, retirement planning, estate planning, and taxation should all be included in the financial plan. Above all, begin investing and stick to your plan. Periodically review your plan. The execution of a financial plan. The plans should be regularly checked and evaluated against the intended goals to ensure successful financial planning. A successful plan requires considerable dedication and regular assessment, once in 6 months, or at a major event such as birth, death, inheritance. Based on the performance of your investments, you should be prepared to make small or big changes to your present financial position, goals, and investment time frame. Thus, personal financial planning is the process of accomplishing life goals through smart financial management. It could be buying a home, saving for higher education, or other ambitious goals set to enjoy a higher standard of living. It is not limited to a specific class, but such behavior should be adopted by all individuals in order to optimize savings. Financial education and investment awareness. 1.7 Economics. Economics is that branch of social science which is concerned with the study of how individuals, households, firms, industries, and government take decisions relating to the allocation of limited resources to productive uses, so as to derive maximum gain or satisfaction. The word economics is derived from the ancient Greek word oikonomikos or oikonomia. Oikonomikos literally translates to the task of managing a household. Adam Smith, considered as the father of modern economics, defined economics as an inquiry into the nature and causes of the wealth of nations. British economist Alfred Marshall defined economics as the study of man in the ordinary business of life. 1.8 Scope of economics. A. Microeconomics. The part of economics whose subject matter of study is individual units, i.c. a consumer, a household, a firm, an industry, etc. It analyzes the way in which the decisions are taken by the economic agents concerning the allocation of the resources that are limited in nature. It studies consumer behavior, product pricing, firms' behavior, factor pricing, etc. B. Macroeconomics. It is that branch of economics which studies the entire economy, instead of individual units, i.e., level of output, total investment, total savings, total consumption, etc. Basically, it is the study of aggregates and averages. It analyzes the economic environment as a whole, wherein the firms, consumers, households, and governments make decisions. 1.9 Factors influencing decision-making and investments. Business environment factors impact how a business industry operates and generates returns. These factors have an impact on the investments and their returns. In broad terms, this environment can be divided into two categories: macro environment and micro environment. Macro environment affects the operation of all existing business entities out there, while microenvironment influences the functionality of a particular business itself. Macroenvironment factors. The macroenvironment comprises a range of external factors. Neither businesses nor governments can entirely control external factors. However, diligent decision, financial education and investment awareness, making and strategies can reduce the impact that these external factors can have on the economy. The external environment has an indirect impact on financial markets. This is not evident immediately but can result in huge losses later on in the absence of a strategic move. On the other hand, a favorable environment presents a variety of profitable opportunities. The economic development of a country depends on these macro environment factors. The factors are as follows. Demographic factors. Demographics refers to age, language, lifestyle, income distribution, cultural differences, etc. Financial literacy depends on demographics. Technology factors. Technological growth and advancement within a nation greatly influences the production and sale of goods or services. Innovation, automation, and internet facilities are some examples of technological factors. Natural and physical factors. Business performance depends on various geographical and ecological forces, availability of natural resources, climate change, conditions, biological balance, pollution, etc. Political and legal factors. The government imposes various regulations on businesses, employment laws, import-export laws, copyright laws, labor laws, health and safety laws, and discrimination laws. These are known as political and legal factors. Right-pointing arrow social and cultural factors. A business needs to be socially responsible and culturally aware. Socio-cultural factors comprise education, population growth rate, life expectancy rate, social status, buying habits, religion, etc. Right-pointing arrow economic factors. Consumer buying decisions are significantly impacted by macroeconomic factors: demand, supply, inflation, interest rates, taxes, exchange rates, and recession. 2. Microenvironment factors. The microenvironment of the organization consists of those elements which are controllable by the management. However, the microenvironment does not affect all the companies in an industry in the same way, because the size, capacity, capability, and strategies are different. Some of the key microenvironment business factors are listed below. Plus customers, plus suppliers, competitors, the general public, financial education and investment awareness. 1.10 Banking in India. A bank is a type of financial institution that is licensed to accept deposits and provide loans. Financial services such as wealth management, currency exchange, and safe deposit boxes may be offered by banks. Retail banks, commercial or corporate banks, and investment banks are among the several types of banks. The banking industry manages a country's finances, including cash and credit. Banks play an important part in a country's economic standing. Banks are strictly regulated in most nations due to their importance in the economy. In India, the Reserve Bank of India, RBI, is the apex banking authority in charge of the country's monetary policy. Banking company. The Banking Regulation Act, 1949 defines a banking company as a company which transacts the business of banking in India. Section 5, c. Banking. Section 5b defines banking as accepting for the purpose of lending or investment of deposits of money from the public, repayable on demand or otherwise, and withdrawable by check, draft, order, or otherwise. The term bank is derived from the French word banco, which means a bench or money exchange table. 1.11 Functions of banks. Acceptance of deposit. A bank accepts money from the people in the form of deposits which are usually repayable on demand or after the expiry of a fixed period. It gives safety to the deposits of its customers. It also acts as a custodian of funds of its customers. Greater than giving advances, loans. A bank lends out money in the form of loans to those who require it for different purposes. These loans can be in the form of retail loans, loans given to individuals, or corporate loans, loans given to businesses. Payment and withdrawal. A bank provides easy payment and withdrawal facility to its customers in the form of checks, drafts, debit cards, automated teller machines, ATMs, etc. It also brings bank money in circulation. The New Age banking focuses on providing payment services using mobile technology to enable faster transfers, using Unified Payment Interface, UPI, etc. Ever-increasing functions including agency and utility services. Banking is an evolutionary concept. There is continuous expansion and diversification as regards the functions, services, and activities of a bank, which includes wealth portfolio management services, utility services, agency services, insurance, mutual fund advisory services, etc. Financial education and investment awareness. 1.12 Need for banking. A sound banking system is necessary to achieve the following objectives. Savings and capital formation. Banks play a vital role in mobilizing the savings of the people and promoting the capital formation for the economic development of a country. Channelization of savings. The mobilized savings are allocated by the banks for the development of various fields such as agriculture, industry, communication, transport, etc. Implementation of monetary policy. A structured banking system can easily implement the monetary policy because development of the economy depends upon the control of credit given by the banks. So, banks are necessary for the effective implementation of monetary policies. Encouragement of industries. Banks provide various types of financial services such as granting cash credit loans, issuing letter of credit, bill discounting, etc., which encourages the development of various industries in the country. Regional development. By transferring surplus money from the developed regions to the less developed regions, banks reduce regional imbalances. Development of agriculture and other neglected sectors. Banks are necessary for the farmers. It also encourages the development of small-scale and cottage industries in rural areas. 1.13 Types of banks in India. Banks in India. Commercial banks. Small finance banks. Payments bank. Cooperative bank. Public sector banks. Foreign banks. Private sector banks. Regional rural banks. 1. Commercial banks. Financial education and investment awareness. Urban cooperative banks. State-county operative banks. A commercial bank is a financial institution which accepts deposits from the public and gives loans for the purposes of consumption and investment to make profit. Commercial. N. Banks are governed by the Banking Regulation Act of 1949, and their business model is profit-oriented. Their primary function is to receive deposits and lending to individuals, businesses, and governments. Commercial banks have typically maintained physical locations, but a growing number now operate exclusively online. Commercial banks are vital to the economy because they provide the market with capital, credit, and liquidity. Commercial B can be divided into public sector banks. These are the nationalized banks, which account for more than 75% of the country's overall banking industry. Public sector undertakings, banks, are a major type of government-owned banks in India, where a majority stake, i.e., more than 50%, is held by the Ministry of Finance of the Government of India or State Ministry of Finance of various state governments of India. The main goals of public sector banks are to ensure accessibility of banking and financial services, to ensure regulatory compliance, to promote the needs of the underprivileged and weaker sections of society, to cater to the needs of agriculture and other priority sectors, and to prevent the concentration of wealth and economic power. The number of public sector banks has been reduced to 12 from 27. Greater than private sector banks. Private sector banks are those in which private shareholders own the majority of the company rather than the government. Private promoters own, manage, and govern private sector banks, which are free to operate in accordance with market forces. Apart from the shareholding structure, both public sector and private sector banks offer the same set of services. To ensure their safety and smooth operation, entry hurdles and regulatory criteria such as the minimum net worth are normally in place. This assures the protection of public deposits entrusted to such organizations, and they are also governed by rules provided from time to time by Reserve Bank of India. At present, there are 21 private banks in India, as on 2021. Foreign banks. A foreign bank is a financial institution that provides financial services to international consumers from outside of its native country. Foreign banks are registered and have their headquarters in another country, yet they have branches in India. These banks can operate or finance through branches or wholly owned subsidiaries. According to the RBI, most foreign banks' primary business in India has been in the corporate sector. Regional rural banks. On October 2, 1975, the Indian government established regional rural banks, RRBs. They were established to provide banking and financial services to remote communities and therefore operate in several states in India. These banks help small and marginal farmers in rural areas by providing finance. They help small and marginal farmers, agricultural laborers, artists, and small business owners get finance. Scheduled banks, often a nationalized commercial bank, sponsor RRBs. Financial education and investment awareness. 11. 2. Small finance bank. Small financing banks were established with the goal of reaching out to the unbanked population in distant and underdeveloped locations. Small finance banks, SFBs, became public in India on September 16, 2015, when the Reserve Bank of India authorized the establishment of small financial institutions known as small finance banks in accordance with the Union Budget of 2014-2015. The goal of India's small finance banks is to give financial inclusion to the less privileged sectors of the economy, who may be unable to access financial institutions. Small finance banks serve small and micro businesses, marginal and small farmers in the unorganized sector. 3. Payments Bank. The Reserve Bank of India conceptualized payments banks as a new type of bank in India, RBI. These banks can accept a limited deposit, which is now capped at 200,000 per person but could be raised in the future. These banks are unable to provide loans or credit cards. Banks of this type can handle both current and savings accounts. Payments banks can provide online and mobile banking as well as ATM and debit cards. Bharti Airtel established Airtel Payments Bank, India's first payments bank. Examples of payments bank in India are as follows: Airtel Payments Bank Limited, India Post Payments Bank Limited, Paytm Payments Bank Limited, Jio Payments Bank Limited, NSDL Payments Bank Limited. 4. Cooperative banks. Cooperative banks are governed by an elected managing committee and are governed by the Cooperative Societies Act of 1912. A cooperative bank is a voluntary that caters to its members' financial requirements on a mutual basis. They take deposits and lend money to their members in the form of mortgages and other sorts of loans. The Reserve Bank of India regulates and inspects these banks as well, but they are normally governed by a distinct statute that is more flexible and easier to comply with than central bank legislation. Cooperative banks are further divided into the following categories. Urban cooperative banks. The primary cooperative banks in urban and semi-urban areas are referred to as urban cooperative banks. Small borrowers and enterprises oriented around towns, neighborhoods, and workplace groupings were primarily lent to by these banks. State cooperative banks. The short-term cooperative credit framework includes state cooperative banks. State governments register and regulate these organizations under the relevant state cooperative societies acts. They are also under the authority of the RBI because they are subject to the rules of the Banking Regulation Act, 1949. Financial education and investment awareness. 12. 1.14 Types of bank deposits. A commercial bank's most significant activity is to collect deposits from the general public. People who have extra money in savings find it convenient to deposit it in a bank. Funds deposited with a bank receive interest depending on the nature of the deposit. Banks typically accept the following types of deposits. Types of bank deposit account: savings account, current account, fixed deposit, recurring deposit. 1. Savings account. Individuals who want to deposit small sums of money from their present income should open a savings account. It assists them in securing their future while also collecting income on their investments. A savings account can be opened with or without the ability to use a checkbook. Savings account customers can also deposit checks, draft, dividend warrants, and other instruments made in their favor with the bank for collection. Types of savings accounts. A. Basic savings account. A basic savings account is a simple account that can be opened with a bank or financial institution. Its sole goal is to save your money in a safely manner. In exchange, you will receive interest on the amount you have deposited. The interest rate varies from one bank to another. Basic savings accounts often have a minimum balance requirement, and you must ensure that your account balance does not go below a certain level. B. Instant savings account. An instant savings account is quite similar to a basic savings account in many ways. The main distinction is that regular savings account may need you to physically visit the bank to open it. An instant savings account may be started fast online with only a few clicks. Only your Aadhaar details can be used to start an instant savings account. It also has a variety of other benefits, including as app-based access to banking services 24 hours a day, 7 days a week. Financial education and investment awareness. 13. C. Zero balance savings account. A zero balance savings account is one in which account holders are not required to maintain any monthly average amount, AMB. D. Family savings account. Family savings accounts are accounts that allow all members of your family to manage their varied financial needs on a single platform. It has a numerous benefit over a conventional individual savings account, including lower minimum balance requirements, expanded banking privileges, and superior features such as wealth management and private banking. 2. Current account. Current bank account is opened by businessmen who have a higher number of regular transactions with the bank. It includes deposits, withdrawals, and contra transactions. It is also known as demand deposit account. The depositor can withdraw the balance of his or her current account at any time using checks. Business organizations or businessmen are allowed to open current accounts. Current accounts do not pay interest because the money put in them is repayable without restriction on demand. Features of a current account. A current account requires a higher minimum balance than a savings account. Designed to make frequent transactions easier, such as transferring funds, receiving checks and cash. Individuals, proprietary businesses, public and private companies, association, trusts, and so on can generally operate current accounts. The primary goal of current account is to foster business transactions. Current accounts charge interest on short-term cash borrowed from the bank by the account holder. E. Fixed deposit. The word fixed deposit refers to a deposit that is repayable after a set duration of time. It is also known as a time deposit since it is repayable only after a set duration of time, which is chosen at the time the account is opened. Fixed deposits are the most beneficial to a banking institution. Because they are only repayable after a set period of time, the bank can invest these funds more profitable by lending at higher interest rates and for longer periods. IV. Recurring deposit. Recurring deposit, ROD, are a type of account in which the depositor is required to deposit money at regular intervals such as monthly, quarterly, or weekly for a set duration of time. Most banks and NBFCs in India offer recurring deposit accounts with terms ranging from 6 months to 10 years. The interest rate typically fluctuates between 5.00% and 7.85%. After the prescribed period has expired, the financial education and investment awareness. 14. Customer receives all of his deposits, as well as the cumulative interest accrued on the deposit. FD versus ROD. Difference. Fixed deposit. 1. Deposit frequency. 2. Tenure. Only once. 7 days to 10 years. 3. Interest payout. Periodically maturity. Or recurring deposit periodically. 6 months to 10 years. On maturity along with the capital amount. 4. Minimum deposit. 100 rupees. 1000 rupees. 5. Tax saving option. Available with 5 years maturity. Not available. 1.15 Deposit Insurance, PMJDY. The Pradhan Mantri Jan Dhan Yojana, PMJDY, sets out to provide a basic bank account to every family who till now had no account. The bank account comes with a RuPay debit card with a built-in accidental insurance cover of 1 lakh rupees. During the launch on 28.08.14 in New Delhi, Honorable Prime Minister also announced a life cover of 30,000 rupees per for those subscribing to a bank account with a RuPay debit card before the 26th of January 2015 to complement the 1 lakh rupees accident insurance cover. This life insurance cover of 30,000 rupees per under Pradhan Mantri Jan Dhan Yojana gives life insurance cover on death of the life assured, due to any reason, to the deceased's family. The scheme aims to provide security to families from economically weaker sections who cannot afford direct purchase of such insurance. The premium subscription for the life cover under PMJDY is borne by the Government of India. 1.16 Traditional and new banking models. India has traditionally been a cash-based economy. The government's decision to implement demonetization, as well as the recent COVID epidemic, has mandated contactless payments and increased cashless banking. Demonetization may have failed to attain its stated goals like seizing all black money and undeclared assets, but it did disrupt life and economic activity. The positive side of demonetization is that compelled people to conduct cashless transactions because there was very little liquid currency available to the public as the government had banned old currency notes. Many digital payment services emerged, assisting people to transition to cashless purchases. The imposition of demonetization in 2016 paved the way for a cashless banking. Financial education and investment awareness. 15. 1.17 Methods of new banking models. Banking cards. Banking cards. Banking cards, such as debit and credit cards, are among the most widely used cashless payment systems worldwide. Banking cards provide numerous benefits such as secure payments, convenience, and many others. One of the most significant benefits of banking cards is that they may also be used to make digital payments. To perform cashless payments, a user can store his card information in mobile wallets or digital payment apps. The types of bank cards and their characteristics. Debit card. Debit cards are provided when an account is opened at a bank. Debit cards are linked to a bank account and enable you to pay at both physical and online stores, as well as withdraw cash from branches or ATMs. Upon using debit card, the amount will be debited from your savings or current account. As a result, if there were insufficient funds and the transaction could not be completed, the debit card normally has a daily limit connected with it for security concerns, especially when withdrawing cash from an ATM. Credit card. The primary distinction between a debit card and a credit card is that when we use the debit card, the amount is deducted from the bank account. When we use a credit card, the amount is deducted from the pre-approved credit limit rather than the bank account. The card's limit is determined by the issuing institution based on the credit score and history. In general, a higher credit score results in a greater credit limit. Mobile application-based payment system. Because of the rapid, safe, and easy payment options, mobile wallet applications are increasingly gaining popularity. Mobile apps enable users to transfer, receive, and store money. By simply integrating the bank account, a user can add or save money in his wallet. The following are the types of mobile payment apps: e-wallets, digital wallets, open e-wallets, semi-closed e-wallets, closed e-wallets. Financial education and investment awareness. 16. 1. Open e-wallets. Banks are the only institutions authorized to issue and operate open wallets. Users with open wallets can use them for any transactions, including the purchase of products and services, as well as financial services such as money transfer at merchant locations or point-of-sale terminals that accept cards, and cash withdrawal at ATMs. RBI authorization or prepaid payment instruments, PPIs, license is not required for banks for operating open e-wallets. Examples: Yono, State Bank of India; Lime, Axis Bank; Pockets, Assisi Bank. 2. Semi-closed e-wallets. A semi-closed wallet is issued by a fintech or by any payments company, non-bank entity. Using this type of app, a user can also transact with merchants that have a contract with the app company. Merchants need to sign contracts with the app company for accepting payment from the mobile wallets. Semi-closed wallets also do not permit cash withdrawal. Since semi-closed wallets are administered by non-bank entities, they are mandated to keep money in the escrow account with a partner bank. RBI authorization or prepaid payment instruments, PPIs, license is required for closed wallet companies. Examples: Paytm, PhonePe, Google Pay. 3. Closed e-wallets. A closed e-wallet is issued by a merchant to a consumer for buying goods and services exclusively on its platform. Cash withdrawal or redemption are not possible with these wallets. Typically, merchants create these wallets account for customer to refund money in the event cancellation or return of a product or service. RBI authorization or prepaid payment instruments, PPIs, license is not a compulsion for closed wallet companies. Examples: Flipkart, MakeMyTrip. BIM, UPI. Based on the Unified Payments Interface, BIM is an Indian mobile payment app developed by the National Payments Corporation of India. BIM, Bharat Interface for Money is a UPI-based platform that allows users to make secure, simple, and instant digital payment using your phone. The Unified Payments Interface, UPI, is a real-time payment system designed by the National Payments Corporation of India, NPCI, that allows for interbank peer-to-peer, P2P, and person-to-merchant, P2M, transactions. The Reserve Bank of India, RBI, regulates the interface, which works by immediately transferring payments between two bank accounts on a mobile platform. D. QR codes. QR is an abbreviation for Quick Response. It is a two-dimensional code that consists of a pattern of black squares grouped on a square grid. Imaging devices, such as financial education and investment awareness. 17. Smartphone cameras can scan QR codes. QR codes are extensively used for conducting cashless payments, in which a user just scans the merchant service QR code to complete the transaction. E. Contactless payments. Contactless payment is a simple and safe technology that allows users to buy products by just tapping a card near a point-of-sale terminal. The card can simply be a debit, credit, or smart card based on NFC, near-field communication, or RFID technology. Because contactless payments do not require a signature or a PIN, they are highly convenient. Furthermore, contactless payments can be made using NFC-enabled phones that are directly linked to a mobile wallet. To make the payment, the user merely needs to keep his NFC-enabled phone close to the reader. F. ECS. Electronic Clearance Service is extensively used for making bulk payments, equating monthly installments, paying off utility bills, and disbursing payments such as dividends, pensions, and salaries. ECS can be used for credit as well as debit services. To begin the ECS, the bank must obtain authorization to make periodic credits and debits. ECS is a secure technique since you may specify the maximum amount of debit, the validity time, and the purpose of the transaction. G. Online fund transfer. There are several methods for transferring funds from one bank account to another. With the advancement of technology, online money transfer has become the most convenient method of sending funds from one bank to another. Here are the three most common methods of money transfer. 1. NEFT. The National Electronic Fund Transfer, or NEFT, is the most basic and widely used method of transferring money from one bank to another. To complete a NEFT transaction, you just need two pieces of information: the account number and the IFSC code of the destination account. There is no limit to the amount of money that can be transmitted via NEFT. Individual banks, on the other hand, may impose a limit. 2. RTGS. RTGS is an abbreviation for Real-Time Gross Settlement. RTGS is a real-time funds transfer system based on the gross settlement principle, in which money is sent from one bank to another in real time. RTGS is primarily intended for high value. As a result, while there is no maximum transfer amount, you must send a minimum of 2 lakh Indian rupees at a time. When the transaction amount is high and payment must be processed instantly, RTGS is extremely important. A typical RTGS transfer, like NEFT, requires the beneficiary's name, account number and type, the name of the bank, and the Indian Financial System Code, IFSC, of the bank. Financial education and investment awareness. 18. 3. IMPS. Immediate Payment Service, IMP, is a service that allows for instant financial transfers and can be used at any time. IMPS is simply the combination of NEFT and RTGS. The transaction limit is set quite low in order to avoid fraud complaints. You only need the destination account holder's IMPS ID, MMID, and mobile number to make an IMPS transfer. H. Gift cards or vouchers. Gift cards are also a convenient option to go cashless. It allows the recipient to use a voucher to purchase anything. There are also a number of stores that provide discounts on gift cards. 1. ATM. TMs, or automated teller machines, are one of the most useful innovations in the banking industry. ATMs enable banking customers to do self-service activities such as cash withdrawal, deposit, and fund transfers in a timely manner. In 1967, ATMs were first used in London. HSBC opened the first ATM in India in Mumbai in 1987. ATMs can be on-site or off-site. ATMs on-site are found at banks. By using ATMs, customers benefit from increased choice, convenience, and availability, while banks increase transaction income, reduce operating and maximize staff resources. 1.18 Financial Statements, Financial Terms and Overview. 1. There are two basic types of income: A. Revenue, self-generated fees for service sales. B. Support, charitable contributions and grants. 2. Financial information is based on periods of time. A. Past financial statements, prepared monthly, quarterly, annually to reflect historical activity. B. Present reality cash flow projections, include current and near-term cash projections. C. Future equals budget, prepared in anticipation of future activity. 1.19 Types and uses of financial statements. Financial statements are a compilation of financial data, collected and classified in a systematic manner according to the accounting principles, to assess the financial position of an enterprise as regards to its profitability, operational efficiency, long and short-term solvency, and growth potential. They are structured financial representation of the financial position, performance, and cash flows of an enterprise. Financial education and investment awareness. 19. Generic, for-profit, non-profit. Balance sheet. Statement. Financial. Governmental. Position. Of. Statement of net assets. Income statement. Changes in net assets. Statement of activities. Statement of activities in A. Income statement, profit and loss statement. The profit and loss account, income statement, shows the financial performance of the company, firm over a period. It indicates the revenues and expenses during that particular period. The period is an accounting period per year, April to March. The accounting report summarizes the revenue items, the expense items, and the difference between them, net income, for an accounting period. B. Balance sheet. A balance sheet is a financial statement that reports a company's assets, liabilities, and shareholder equity. The balance sheet is one of the three core financial statements that are used to evaluate a business. The balance sheet adheres to the following formula: assets, liabilities plus shareholders' equity. A balance sheet contains the following: black circle assets. Assets in a balance sheet shows the amount of assets an entity holds on the date of the balance sheet. Liabilities. Liabilities in balance sheet shows the amount of liability an entity is liable to pay in future, determined on the date of balance sheet. Equity and reserves. Equity and reserves is the amount of capital the entity has including reserves balances, if any. Higher amount of equity and reserves indicates higher net worth of the entity. C. Cash flow statement. Cash flow statement, also known as statements of cash flow, shows the flow of cash and cash equivalents during the period and breaks the analysis down to operating, investing, and financing activities. It helps in assessing liquidity and solvency of a company and to check efficient cash management. There are three key components of cash flow statements. Black circle cash from operating activities. This includes all the cash inflows and outflows generated by the revenue-generating activities of an enterprise like sale and purchase of raw materials, goods, labor cost, building inventory, advertising, shipping the product, etc. Black circle cash from investing activities. These activities include all cash inflows and outflows involving the investments that the company made in a specific time period, such as the purchase of new plant, property, equipment, improvements, capital expenditures, cash involved in purchasing other businesses or investments. Black circle cash from financial activities. This activity includes inflow of cash from investors such as banks and shareholders by getting loans, offering new shares. Financial education and investment awareness. 20. Etc., as well as the outflow of cash to shareholders as dividends as the company generates income. They reflect the change in capital and borrowings of the business. 1.20 Important ratios. Ratio is a meaningful relationship between two financial parameters. Ratios are best interpreted in comparison with historical data, competition, and industry norms. Measures for understanding financial health. 1. Current ratio. This ratio is used to assess a firm's ability to meet its current liabilities. The relationship of current assets to current liabilities is known as current ratio. The ratio is calculated as current ratio equals current assets, current liabilities. 2. Liquid ratio. This ratio is used to assess the firm's short-term liquidity. The relationship of liquid assets to current liabilities is known as liquid ratio. It is also called the acid test ratio or quick ratio. The ratio is calculated as liquid ratio equals liquid assets, current liabilities. 3. Debt equity ratio. This ratio helps to ascertain the soundness of the long-term financial position of the concern. It indicates the proportion between total long-term debt and shareholders' funds. This also indicates the extent to which firm depends upon outsiders for its existence. The ratio is calculated as debt equity ratio equals total long-term debt, shareholders' funds. 4. Return on equity ratio. It measures the returns of the company is generating on shareholders' equity. Return on equity equals profit after tax, equity share capital. 5. Return on capital employed, ROCE. The comparison is between operating profit and total capital employed including debt. ROCE equals profit before interest and tax, total capital employed. 6. Inventory turnover ratio. The inventory turnover ratio is an efficiency ratio that shows how effectively inventory is managed by comparing cost of goods sold with average inventory for a period. This measures how many times average inventory is turned or sold during a period. Inventory turnover ratio equals cost of goods sold, average inventory. Financial education and investment awareness. 21. 7. Gross margin ratio. Gross margin ratio is a profitability ratio that compares the gross margin of a business with the net sales. This ratio measures how profitably a company sells its inventory or merchandise. This is the pure profit from the sale of inventory that can go to paying operating expenses. Gross margin ratio equals gross margin, net sales. A gross margin equals net sales, cost of goods sold. B net sales equals gross sales, returns, refunds. 8. Net margin ratio. It is the percentage of revenue left after all expenses have been deducted from sales. The measurement reveals the amount of profit that a business can extract from its total sales. Net margin ratio equals net profit, total sales. 1.21 Role of RBI as banking regulator. The Reserve Bank of India was established on April 1, 1935 in accordance with the provisions of the Reserve Bank of India Act, 1934. The preamble of the Reserve Bank of India describes the basic functions of the Reserve Bank as under: to regulate the issue of banknotes and keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage, to have a modern monetary policy framework to meet the challenge of an increasingly complex economy, to maintain price stability while keeping in mind the objective of growth. 1.22 Main functions of Reserve Bank of India. Monetary authority. Formulates, implements, and monitors the monetary policy. Objective. Maintaining price stability while keeping in mind the objective of growth. Regulator and supervisor of the financial system. Prescribes broad parameters of banking operations within which the country's banking and financial system functions. Objective. Maintaining public confidence in the system, protect depositors' interest and provide cost-effective banking services to the public. Manager of Foreign Exchange. Manages the Foreign Exchange Management Act, 1999. Objective. Facilitating external trade and payment and promote orderly development and maintenance of foreign exchange market in India. Financial education and investment awareness. 22. Issuer of currency. Issues, exchanges and destroys currency notes as well as puts into circulation coins. Minted by Government of India. Objective. To give the public adequate quantity of supplies of currency notes and coins and in good quality. Developmental role. Performs a wide range of promotional functions to support national objectives. Regulator and supervisor of payment and settlement systems. Introduces and upgrades safe and efficient modes of payment systems in the country to meet the requirements of the public at large. Objective. Maintaining public confidence in the payment and settlement system. Related functions. Banker to the government. Performs merchant banking function for the central and the state governments. Also acts as their banker. Banker to banks. Maintains banking accounts of all scheduled banks. 1.23 Time value of money. The concept of time value of money is based on the principle that a rupee today is more valuable than a rupee receivable in future. This means money available at the present time is worth more than the same amount in the future due to its potential earning capacity. This happens because money received in future involves risk and uncertainty, and money available at present provides investment opportunities as it can earn interest. Therefore, any amount of money is worth more the sooner it is received. 1.24 Importance of time value of money. Money today is worth more than money in the future. This is called the time value of money. There are three reasons for the time value of money. inflation, risk and liquidity. 1.25 Calculation of time value of money. To calculate the time value of money, following are the required terms. Present value. This is the sum of money you have today. Future value. This is the sum of money you will have at some later time. Greater than discount rate is the percentage rate that is used to determine the present value of the future amount. It can often be approximated at the interest rate. Formula. Present value equals future value, 1 plus discount rate. Financial education and investment awareness. 23. 1.26 Present value calculation. 1. To have 2,000 today, you would have needed to invest some money a year ago. Your future value is now 2,000, and you would use the discount rate of 7%. Calculate present value. Sol. Present value equals 2,000 over 1.07 equals 1,869 rupees and 16 paise per. 1.27 Future value calculation. 1. Mr. Gupta deposits 2,000 at the end of every year for 45 years in his saving account, paying 5% interest compounded annually. Determine the sum of money he will have at the end of the 5-year. Sol. End of year. Amount deposited. No of years compounded. 2,000. 2. 2,000. 3. 2,000. Amount at the end of 5th year equals 2,432 plus 2,316 plus 2,206 plus 2,100 plus 2,000 equals 11,054 rupees per. 2. What is the compound interest, C, on 10,000 rupees for 2 years at 10% p, a compounded annually? Sol. Formula. A equals P, 1 plus, R, 100, N. Equals 10,000, 1 plus, 10 100ths, equals 10,000 asterisk 1.21 equals 12,100 rupees per. Compound interest 12,100 to 10,000 2,100 rupees per. 2,206. 24. Practical module. 1. Spreadsheet modeling. A. If function. The if function is a pre-made function in Excel, which returns values based on a true or false condition, as it allows to make logical comparisons between a value and what we expect. Equals if, logical underscore test, value underscore if underscore true, value underscore if underscore false. B. Sum function. The SUM function is a pre-made function in Excel, which adds numbers in a range. Equals sum, select the range. C. Average function. The average function is a pre-made function in Excel, which calculates the average, arithmetic mean, equals average, select the range. D. VLOOKUP function. The VLOOKUP function is a pre-made function in Excel, which allows searches across columns. It is used to find things in a table or arrange by row. Equals VLOOKUP, lookup underscore value, table underscore array, call underscore index underscore num, range underscore lookup. Lookup underscore value. Select the cell where search values will be entered. Table underscore array. The table range, including all cells in the table. Call underscore index underscore num. The data which is being looked up. The input is the number of the column, counted from the left. Range underscore lookup. 0 for exact match, 1 for approximate match. E. Max function. The max function is a pre-made function in Excel, which finds the highest number in a range. Equals max. Select the range. F. Min function. The min function is a pre-made function in Excel, which finds the lowest number in a range. Equals min. Select the range. G. NPV function. NPV, net present value, is a financial formula used to discount future cash flows. Equals NPV, rate, value 1, value 2. Financial education and investment awareness. 25. 2. Statistical functions in Excel. A. Median function. The median function is a pre-made function in Excel, which returns the middle value in the data. Equals median, select the range. B. Mode function. The mode function is a pre-made function in Excel, which is used to find the number seen most times. Equals mode, select the table, range. C. Standard deviation function. The STDEV S function is a pre-made function in Excel, which calculates the standard deviation, STD, for a sample. Standard deviation is a measure of the amount of variation or dispersion of a set of values. Equals STDEV S. Select the range. Sample financial plan for a young adult. Name: Miss, Mr. Age 19 years. Goals. Goal type. Name. Target date. Amount in Rs. Education, M.Com. Short term. Self. 2023. 3 locks. Action plan required. Financing my fees partly from my parents' funds and partly by taking loan. Car. Medium term. Self. 2027. 10 locks. Vacation. Medium term. Parents. 2028. 1 lakh. By 2024 it is expected that I will start earning money. So I can save 1 lakh rupees every year and I will make down payment to buy a car. Also keeping in mind this goal, I can make suitable investments like equity and mutual funds to earn sufficient returns to fund the vacation for my parents. 26. Questions. Section A. 1. What is personal financial planning? 2. Mention the examples of short-term and long-term financial goals. 3. What do you mean by economics? 4. What is meant by bank? 5. What do you mean by deposit insurance, PMJDY? 6. What is meant by balance sheet? 7. What do you mean by cash flow statement? 8. What is time value of money? 9. Excel function. A. If B, sum C, max D, min E, average F, mean G, median. Section B. 1. What are the steps in the personal financial planning? 2. What are the factors influencing decision-making in investments? 3. What is the difference between fixed deposit and recurring deposit? 4. Explain the main functions of Reserve Bank of India. 5. Explain the types of bank deposits. 6. Explain the types of savings bank deposit. 7. What do you mean by time value of money? Explain the importance in calculation of time value of money. 8. To have 3,000 today, you would have needed to invest some money a year ago. Your future value is now 3,000, and you would use the discount rate of 10%. Calculate present value. 9. What is the compound interest, C, on 10,000 rupees for 2 years at 10% p.a. compounded annually? Section C. 1. Explain the essential features of financial goals with example. 2. Explain the types of banks in India. 3. Explain the methods of new banking models. 4. Explain any 6 important ratios to measure financial health. 5. What are the functions and needs of banking? Financial education and investment awareness.